Hi, I'm Steve Dudash, IHT Wealth Management. Welcome to this week's Wealthcast. All right, I want to do our year out projections. I want to look at our projections from last year too. But first, and I don't do enough of this, so I want to get it out there. You know, to all of our clients, to all the advisors that are with us, to all the staff and people that help out our firm, I just want to say thank you. I don't do a very good job of this all the time. I get really into the growth part, but I don't ever really look back very well and say thank you to everyone who's a part of this. You know, we've got 12 or 13 states, 20-something offices, tens of thousands of clients. So thank you for being a part of this. Thank you for the clients who watch this. Thank you for being part of this firm. We really, really appreciate it. We really do. So, that out of the way. Let's talk about projections. Last year, couple of things that we talked about were spot on. We said avoid Bitcoin like the plague, down like 80% from last year at this time. It had no substance. It will eventually be out of business or dissipate or whatever you want to call it. I don't know what else to say. It was bad. We were right. It's bad. It turned out to be bad. It was all hype. Tesla, lots of hype too. I think Tesla's got a little bit more legs under them, but the stock price was all about the hype, not about the reality. And I think now it's starting to get more to the reality. That being said, we were spot on. It's down like whatever, 30-40% since we did that video. So we were spot on there. But I will say that at least it now comes across they're running this thing more like a business versus a marketing machine. But we weren't right with everything. I was big on saying do international. I thought it'd outperform the US because the valuations were very, very strong comparatively. That turned out to be wrong. Europe, everyone lost money. All the major indices lost money last year, but Europe lost more than the US, so I was wrong on that, I'll admit it. I will still say the valuations over there are much cheaper than the US ones, but they've got a lot of other political risks that they just haven't been able to work out. I thought they'd be a little bit further along on that, and they're not. So, that being said, 2019, a couple things. One, this applies to most people watching this. Whereas before it looked like there was going to be multiple rate hikes this year, now they're talking about one, maybe zero. Actually, the markets are pricing in even the possibility of a cut. Now, that is a big unknown, but it's a good thing. And it's a good thing that we raised rates last year because by doing that, it gave us the option or the flexibility to have those choices. Europe, Japan, you know, they don't have that flexibility anymore. They're still at zero or negative rates of return, interest rates. They don't have that flexibility that we do. And so if we do have a down cycle here, which some people are predicting, I don't think it's as realistic as others, but whatever. If there is a down cycle, we have some ammo to help cushion that blow or get through that blow, whereas I think a lot of other parts of the world economy don't have as much flexibility. And that is why I do want to say, for the first time in a little while, I'm against the European movement, or I should say, I don't think Europe's going to outperform. I still think their valuations are better than the US, but until they can work out their political risk, I wouldn't jump in on that. I do think the US is priced fairly, but also emerging markets are looking cheap right now. And that being said, if I had to say one area that's going to outperform, even with the 9% returns we saw in the US this year, which kind of juices them a little bit. I think the emerging markets will outperform if you're weighing them on an even playing field right now. That being said, I also think the US market's going to end up positive. Again, that's cheating a little bit since January was up 9%, but you know, relatively speaking. And I do want to point out one other thing. Last year we said low single digits for the US markets. If you include January, we were right. It would have been like positive 4% or whatever, 4.5%. So the calendar cut us by about 3 weeks, so we would have been spot on that one too. That being said, low single digits, mid single digits this year in the US. I think emerging markets outperforms. International, mostly Europe, flat, if not negative, depending on how Brexit works out. That's the main stuff. I know this video is going a little bit longer than we normally want to talk about, but if you want to talk in more details about this, please let me go. And I'm hoping, this is my one hope for 2019, I'm hoping that some of these politicians on both sides of the aisle get around to realizing that our debt is so out of hand right now, it's only going to make it more unbearable, unfixable the longer we push this out. So my 2019 hope which won't come true because I've said this many years in the past, is that our political world can actually come together and agree that our current debt situation is not sustainable, and let's actually try to fix it. So, that being said, long video, I apologize. If you have any questions, call, email anytime. Have a nice weekend. Take care.